to us, it's more investing in those companies that are benefiting from this major tide of electrification, digitalization.
A warm welcome to viewers tuning in to Assay TV. I'm joining Michel Brutti, CEO and founder of Clear Skies Investment Management. And Clear Skies are a pioneering fund with impact at the center of their investment thesis. And we're going to be hearing all about the true focus of impact investing. So Michel, could you introduce Clear Skies and how you came about setting up the fund?
Well, basically, I worked all my career and all my life, basically, as an investor, and moved towards responsible investing quite early in the early 2010, and I realized that even though we were doing a lot of work on ESG and on responsible investing, there was clearly a lot of greenwashing happening and a lot of washing just in general happening. And I thought that, the way we can tackle some of those major issues that the world is facing, such as climate change, I thought that impact investing is clearly the next step and clearly the solution that people should be really focused on impact investing if they really want to address some of those major issues that the world is facing today. So impact investing, there is a difference between impact investing and sustainable or responsible investing.
Right.
And the main difference with impact investing is that there is intentionality. So you start with impact and you start with an objective in terms of intentions and intentions to, for example, to be dealing with climate change and to be net zero by 2050. That's an intention. And then you try to find which companies, which investments will bring you there. And that's a concept of intentionality. So the world of sustainable investing or responsible investing and impact investing is sometimes blurry. I agree with that, especially on the public markets. But definitely in impact investing, you do start with a goal. That's what we call a theory of change. You start with a theory of change, and once you have defined your goals, then you try to figure out, okay, what kind of investments will help me to achieve those goals?
Yep, absolutely. Excellent. So is that intentional goal around, say, climate change, is that the pillar then within the value creation process? How do you look at balancing these key pillars of profit and impact versus risk on investment? Of course, everyone wants sort of good intentioned businesses, but you have to balance the investment return, and that's quite difficult when you look at new sectors or emerging technologies in the sort of green or sustainable sphere.
Yes. And it's true, because in the world of impact investing, if you look at it, it's about 2/3 is about impact returns. And then you have concessionary returns, which is probably another, 15% about, and then the rest is more like either philanthropy or just want my capital back or something like that.
Okay.
But that 60%, 66%, which is 2/3, is about market returns, and that's where we are.
Okay.
That's where Clear Skies is definitely operating. The idea is that, yes, you do look at impact first, but then you also look at investments that will bring you market returns or better return than the markets, actually. The idea here is that you will, for climate change, for example, we created our own climate action fund. And our own climate action fund is investing in solutions that deal with climate change. And I do believe that today, as it was, over the last 20 years, you had the technology revolution with IT, and those companies have done, some of them have done extremely well. Overall, the IT sector has done extremely well. For the next 20 or 30 years, I believe that there will be so much innovation in clean technology to deal with climate change. The governments are more and more concerned about climate change, so there'll be more and more policies related to climate change and in favor of those companies that are looking for and that are finding solutions for climate change. So positioning your portfolio this way, I believe, is actually going to be very lucrative. But you first look at impact, and then you look at the financial returns you can get. And if the financial returns are not there in the public market, then you don't invest in that one. If it is in the private markets, you can look for blended finance and look for maybe some other investors who actually don't necessarily want the same kind of returns that you want, and may be prepared to either just have a return of their capital, or even just a bit of okay with some losses. And then you could have a project that was not necessarily good for you as an investment because of the return potential, but with blended finance could actually bring those returns higher for you as an investor.
Yeah, absolutely. And do you have a preference at Clear Skies? You do both, you're on market equities or doing more sort of blended finance and more bigger stakes?
So what we do for now is because we make our funds liquid enough so that you can have subscriptions or withdrawal on a monthly basis. You have a large chunk of it that is in the public markets. And then we follow, of course, the rules of the regulator and have part of it invested in private markets through funds, and we are looking also at some potential direct projects as well.
Very good. Okay, so just thinking about your climate action fund then, how do you see the opportunity within the energy transition? You mentioned some of the technologies, and this is going to be one of the driving themes of our generation, or certainly this decade. It already is. If we can get some of the sort of returns that the tech and software world and Silicon Valley have experienced, then excellent. But within that classification, what types of businesses do you look at? Is it quite broad? Is it companies that are working on efficiencies, fuels, metals, mining projects? Because the energy transitions, it ebbs and flows. We're in an energy crisis where we need the hydrocarbons still.
Yes, clearly. Unfortunately, we cannot just get rid of carbons or fuel, fossil fuel for another certain number of years, unfortunately. So I do believe that the kind of companies that when you think about, decarbonizing basically various industries, and you think about electrification. So one is electrification and digitization and energy efficiency. So when you think about that, you can already start to think about companies that are operating in this environment and are actually providing products that help other companies to be more energy efficient. So there are so many companies out there that are actually starting to provide some technologies and some solutions that you can invest in those companies, and they are the way of the future, in my view. In the case of the mining industry, clearly, in the mining industry, it's a very energy intensive industry. We all know that, but we need our metals, and we need the mining, we need the resources for the world, for the economies to continue working. And clearly, what the mining industry can do is reduce significantly its Scope 1 and Scope 2 emissions by doing a few things. Energy efficiency is one of them. It probably will help reduce the industry its CO2 emission by at least 10 to 20%. And then there is electrification of equipment. And there is a lot to do. And I think a large chunk of reducing the emissions of scope 1 and scope 2 of the mining industry is actually electrification, and whether it's electrification of mining processing equipment or trucks or any moving equipment, transporting equipment. There is a lot to do, and I think if that was all electrified, you probably can reduce your scope 1 and scope 2 in the mining industry by at least 40 to 50%. So you can reach already the first step, like by 2030 or 2035. If those technologies are being today, actually there is already technologies that are available for electrifying the mining equipment in the industry. So it's a question of making those equipment, of course, also commercially viable and competitive vis-a-vis a normal transportation truck using diesel. So we are not there yet, but I think there is over the next 5-10 years there will be a lot of investments for the mining industry and for in this kind of to electrify everything.
Yeah, absolutely. It's a fascinating space to be in and lots changing. I wonder how you interpret something like, I guess it relates to the scope 3 aspect of what's going to come through in the sustainable development goals. But if you were to sort of invest in a battery cell manufacturer, but they in turn use a lithium product that's come from a mine, how do you interpret that changing for a fund manager like yourself when you're looking at the business, when you're looking at provenance in the supply chain? Is that going to become more of an issue, slow things down a bit, or narrow the pool of companies, or is it going to make someone look a little bit more upstream and consider mining companies as well as the downstream elements?
Yeah, so you look at scope 1, scope 2, and you look at scope 3, obviously, and that's where for us, the mining industry is an interesting industry to look at, but it's where we would like to invest is in those mining companies that actually are producing the metal and the minerals of the future. So copper, for example, is needed for electrification of everything. So definitely copper producers are an interesting could be interesting for us. But also all types of production. For example, the production of graphite today is, as you probably know, it's mostly in China but there could be a lot of mining companies. There is graphite in Canada, for example, where I live. And unfortunately, there is not much graphite being today extracted from this great land of Canada. But that could be a way for us to look at some mining companies that are actually looking at projects for extracting graphite. And it will be definitely in a much better regulated environment and cleaner environment than probably in some of the emerging markets where the regulation is much less stringent. So I do believe that it's important to look at scope 1, scope 2, and scope 3. But at the end, it's looking at investing in companies that are providing those solutions for the future. So we know that the electrification also of the car industry is happening. And now, it took a while, but now it's happening very fast. And that is great. It's happening, but then you have to figure out, right, all those batteries that needs to be now, you have to think about recycling. But also you have to think about, what kind of emissions is actually being emitted when you actually produce an electric car, right? And And that's where, you need to, even if you produce lithium, you also need, you have to think about, your own emissions. And if you have to think about, if you are a car battery manufacturer, you have to think the same thing. You have to think of your own emissions as well. And if you electrify all of that all of these industries, I believe that through renewables, also the mining industry could reduce its emissions through renewable energy, right? Using renewable energy for its own electrical supply. So again, that's another way also of reducing its own CO2 emissions. At the end, to go to net zero, the industry may need to do some carbon capture. But I think there is a lot, before doing carbon capture, there is a lot to do in the mining industry to reduce their emissions.
Yeah, absolutely. Certainly. There's good innovations happening, but it's really a cultural shift and a big change, and more for the companies to think about. You mentioned Canada a bit, and obviously you're in Quebec, and Canada's in a good position to sort of lead the charge on some of the clean energy innovations, whether it's hydropower, to actually linking that with the industries, bringing the manufacturing closer to the region, whether that's electric vehicles. Trudeau obviously signed an MOU with Volkswagen and Mercedes the other week around supplying these minerals more cleanly to the EV automotive sector.
Yeah, so clearly Canada is well positioned, especially some of the provinces like BC, Quebec, that have a lot of hydropower, and therefore could produce electricity, clean electricity, in such a way that, and actually could be a solution for producing hydrogen, for example. So there are some discussions, clearly, that Canada could supply hydrogen in many applications. It's actually in the mining industry, you will need because of the energy intensity required, hydrogen could be used in some cases where batteries will not be the solutions, and hydrogen could be the solutions. So I do believe that, not only Quebec is very well positioned, and some of the provinces as well are very well positioned with having the minerals, with having the right minerals there, but also having the right supply, the clean energy supply. And therefore, I think that it's happening. It's happening. Unfortunately, it happened at a slow pace, but it's now happening and accelerating in Canada. That people are realizing, oh yes, we do have all these minerals available. We can have an integrated supply chain where we could actually produce the minerals, and do have produce the batteries and also produce the cars. And so it's being now basically aggregated together. And there are a few good projects that I've seen here in Quebec and elsewhere in Canada where you can see this is happening. So I do believe that Canada is going to be well positioned in the future for that.
Yeah, excellent. And just with regards to the fund, do you focus more heavily on TSX, for instance, or do you take very much a global view in terms of?
No, we take a global view, clearly a global view, and we try to pick the best worldwide.
Selective, indeed. Well, you have to be. But my last question would just be, I'm really interested to get your view as an investor as to how the inflationary environment changes the process or changes the mentality or the thinking or your sort of due diligence, if you like, when you're looking at businesses. Is there any sort of pivot in terms of how fund managers are going to be looking at companies now?
Well, in such strong inflationary environment, definitely the consumer is being penalized.
Yeah,
clearly, and I think we haven't seen much yet, but we're going to start to see more and more of companies that are, for example, in the consumer discretionaries are going to be very much affected. I think the trends that are interesting related to climate change, those are major tides that will still continue, regardless whether we go in a slowdown or in a strong recessionary environment, which is, of course, very difficult to predict. I think that this kind of investments in energy efficiency, for example, for the mining industry, in mining equipment that are the answer for electrification of the mining industry, those kind of companies will continue to do well. The valuations in a lot of those companies, which reached their peak in 2021, now are much more interesting valuations. So those are the kind of things that we are looking at. But clearly, to me, in this kind of inflationary environment, the consumer being affected the way it's just starting to be affected, I would be very careful with everything that is related to consumer discretionary item. I would be very careful with everything that is related to housing, for example, and because we have seen a major, over the last 5-10 years, major returns in the real estate developments and in here in North America. And I think that's something that you could see really slowing down. It's actually, we're starting to see it really slowing down very fast.
Yes, when the premiums on lending go up, everything sort of chokes a bit. Indeed.
And even, so inflation is because you have here a specific environment. You have inflation very strong. So the thrifty, the people who have savings, they are being hurt because your savings earn an interest rate that is much lower than actually the inflation rate. And then if you are today, if you are, you have a big mortgage because you bought a house in the last 2 or 3 years, you're also being hurt because your interest rates are going up significantly. And we haven't seen that kind of environment for quite a while. So I do believe that it's going to be, it's important to be very cautious on the markets today and invest more. To us, it's more investing in those companies that are benefiting from this major tide of electrification, digitalization. I think that will continue to be a major thing for the next 10 years.
Yep, absolutely. That long-term view, indeed. Excellent. Michel, thank you so much for giving us some insights today. It's been really interesting to hear about your views and also to get an insight on Clear Skies. So look forward to catching up perhaps in the future around some of the investment landscape.
Thank you for inviting me, Adam. It was a pleasure.
Thanks for speaking with us, ATV.